On this episode, we talk about the bond market with special guest Phil Mesmin from Picton Mahoney. Welcome to Think at Heart.
All right. So we just finished up with Phil Mesmin from Picton Mahoney on bonds. And man, my mind is blown. I didn't know there was so much to know about bonds. I actually didn't know there was that much to know, but certainly you guys got in. The two of you got into the weeds. I just sat back and basically watched you go at it. What were some of your main takeaways from that?
Yeah, for sure. Yeah, I think some of the main takeaways is just how complex it is once you go outside of government bonds. I think everyone kind of understands how those work and the yields, but once you kind of step away from that, it's a very complex world. As I look at Phil's track record, he's been managing this for the past 11 years. I think his worst year was down a couple of percent, and we've had some epic sell-offs through that period. And so, it's so complex and complicated, and oftentimes people think that they can replicate what they do and what he does in an ETF and in a passive format. But there's so many opportunities when you're active and you're looking in the bond market. I think that if you can get 5 to 7% return from your bonds with low drawdown, and that's really what they're trying to do. So and that's what government bonds used to do. But now we're stuck at that kind of 1.5% rate. We can't do that in portfolios and give you the kind of yields that you're expecting. And so my main takeaway was it's crazy, it's extremely complex, and they have whole teams that look for these opportunities, and as a result of that, they can plan and prepare and do things much better than we can from an individual bond picking perspective.
Right. Yeah. I think the one question that I had coming away from that was what role does a company like that have, from your standpoint, like from an advisor standpoint, why do you go to a company like that?
Yeah, so I do constantly think about that kind of portfolio construction, right? And so you think about what pensions would do, and I know we've had a couple of guys in now. We've had Ryan talk about options, and we've had Tom talk about merger arb. Like, these are sleeves within a diversified portfolio for a pension. And so his kind of style is very unique, that they give a consistent, steady return, long, short bonds. And so I would say, that cannot be, like, I can't replicate that. You and I can't replicate that. We can't go call up the desk and say we want to short BCE bonds to kind of manage your risk within a bond portfolio. So, it's something that I can't replicate. We talked on the podcast about government bonds and my view on I want to have some duration, protection, things like that. That's easy for me to replicate. I can buy it in an ETF. It costs me 10 basis points. And it's passive. It's easy. I can take a directional bet simply. But, I want to take some credit risk. I want yield. I want higher income. I can't replicate that myself. And so these guys do it. It's they're experts in the space, and it costs me 1% to use them. If I had to try to build that out, we need to build out a team of 25 just to do that component within your portfolio.
Yeah. That's the thing, like, as we have more of these expert guests on, it's for you, because you've been doing it for so long, you can keep up with it. But from a Main Street view and to the average consumer, I think it just, echoes or it really accentuates the need to deal with, like, a professional, somebody that knows who the real experts are and who has the best strategies out there, right? Because you're not gonna go to your discount brokerage and get that type of advice, right? And this isn't a plug for us or our industry.
Right.
Just like, no, if you go and listen to that interview that we just did, or any of the expert ones that we did, there's just mountains of information to wade through and to pick the best strategy to not only grow your money but also protect it, right? There's just so much there to
Yeah,
know, and it's not really worth most people's time, right? I shouldn't say it's not worth it.
no, for sure,
They wouldn't
for
even know
sure.
where to start,
Yeah,
right? So
that's right. Yeah, yeah,
that's
yeah.
the main reason why
So
we
I
have
think
these guys
that
on.
that kind of,
Go
for
ahead.
sure. So I think somebody like that, I think Phil, and that kind of strategy should be a component within your fixed income portfolio.
Yeah,
To sum it up.
yeah, for
Yeah.
sure. That's kind of the summary of what we discuss and kind of our overview of it. And if you want to kind of get in the weeds and listen to Ben and Phil really dive deep into the bond world, then
Yeah.
continue on, watch the rest of this video. Welcome to a special episode of Think at Heart. I'm Scott Goodfellow. This is Ben Hart.
Hello.
You know, Ben, we talk a little bit about a lot of exciting things, like, tech stocks are super interesting right now, and cryptocurrency for sure. But we asked around, and, our understanding was our guest is the guy that's going to bring the sexy back to bonds. So without further ado, we'd
So
like
much
to
trouble.
introduce Philip Mesmin from Picton Mahoney. Welcome, Phil.
Thanks, Scott. Thanks, Ben. Hi, everyone.
Yeah. Hello. Hey, look, so I've known Phil, I think probably 7 or 8 years. I've been using your funds within my model portfolios, and you manage a portfolio of bonds that's not the typical government bond portfolio. It's a unique construction, but your performance has been excellent, very steady, even in some volatile periods over the last 10 years. I looked at your performance numbers. You're even in some of the most challenging years, you performed very well. And so I'm excited to hear what you have to say tonight. We get lots of clients trying to understand, the bond world. I think generally people understand stocks because it's quite a bit more simple. There's a index you can look at, you can track it, you can see how the stocks are moving and changing, where bonds are still pretty opaque. So I'm hoping you can unlock maybe some of the mysteries of it tonight. But first, maybe you can tell me and tell the viewers a little bit about yourself, a little bit about your history, how you got into bonds, and then we can go into more detail around what it looks like today.
Sure. So a little dinner chat about bonds, huh? That's kind of how I got into the business, believe it or not. Kidding
Okay.
aside. So I'm obviously with Picton Mahoney Asset Management and joined 11 years ago to build out the income business. And it's been an amazing experience. Picton Mahoney is a great firm. We, our vision as a firm is to help investors achieve their financial goals with greater certainty. And I can't think of a better place to have that conversation than with fixed income, given all of the challenges that currently exist within that market, which I'm sure we'll get into.
Yeah.
From a background perspective, so I got into the business literally at dinner time. My father was a banker at one of the Canadian banks, a senior executive there, and he introduced me into the credit business and saw my first credit file at 15 years old, I think it was, and a bit of a backstory there, and worked for him initially at the bank, and then ultimately wanted to be my own person and left and worked at Merrill Lynch in Toronto for a while, and then spent some time in New York working for Grove Capital, and then came out to Canada and joined Picton Mahoney, as I mentioned, 11 years ago. And it was really neat at the time, sitting around a table with Dave Picton and Mike Mahoney and Art Galloway and Dean Shepard, basically the leadership of Picton Mahoney, and asking the question, what are bonds? What are the risks, and how do you manage those risks? And it's one of those Socratic dialogues you don't get too often in things that you're passionate about in from a vocation perspective. So it was super cool, and we really built the strategy around answering those questions.
So that's that must have been an amazing experience. 11 years ago, that was still pretty much in the infancy of Picton.
Yeah, we've been managing money for a long time as a firm, over 15 years, and well established on the alternative space with our market neutral and equity strategies. And I joined to build out the income business within the firm and have an amazing team that we've brought in over the years.
Right on.
Mm-hmm.
That's good. 15 years old. Credit. I don't know that I've heard that from too many people. Like I was interested in the stock market when I was young. My dad followed the market, so I bought my first stock at 13. But like, not I haven't heard that in credit. So tell me a little bit about that before we jump into fixed income.
Sure. Well, if you think about a bond, what is a bond? A
Yeah.
bond is kind of like lending money to a company,
Okay.
right? And so having, I would say, a banker's perspective, which is my training background where I
Yeah.
originally started, being anchored with that perspective adds a lot of value when you're looking at a company bond. That's
Yeah.
really how to think about bonds. They're like loans to companies, and that's what we do is focus in on
Yeah.
those loans and figure out what makes sense to buy.
Yeah. Okay. Well, I think that we try to educate as much as we can, and the one thing I think people still don't understand is the size of the bond market. So what's today's present size of the bond market? Give me a
Yeah,
scale.
the bond market is massive. It's 10 times the size of the equity market. It is, really the biggest market in the world, and it covers government bonds and corporate bonds, which is what we participate in,
Yep.
and globally emerging markets and developed markets, et cetera. Our wheelhouse is corporate credit
Mhm.
in the developed markets specifically. That's where we focus within our strategies.
Yeah. Which is
Maybe I'll just jump in there, Ben, for a sec.
sure. Yeah.
Maybe
Yep.
I'll just jump in there for a second. Maybe this is a question that maybe you can answer as well, Ben. Is what is the role of the bond in most people's portfolio? Just trying to
Yeah, it's a
take it down to the consumer level.
Sure.
sure. That's a great question. Ben, you want to take it first? You want me to run at it?
No, go ahead. Go ahead. I'll add my 2 cents after.
Okay, so if you step back and say, okay, why do you even buy a bond? It serves a couple purposes. So the first is to give you income. So it provides, in theory, that steady income that you need within your overall portfolio. And the second is to provide safety. So when the equity market sells off, you're hoping that the bond market will rally and offset that. So it's known as a flight to quality asset class, historically, anyways. And so those are the two roles: so safety and income.
Yeah. Yeah, I would say that, and there's probably within that there's two sleeves. The safety would be the high quality AAA government type of issues, which hypothetically should go up when equity markets go down. Where the other corporate credit like you that you work with would be kind of a mix, I guess, and those would be higher income paying. These are where you'd uncover a lot of different ideas compared to government bonds. Most people, I think, understand government bonds, or corporates would be higher yielding. This would be a place where we generate some better consistent cash flow in clients' portfolios.
Mm.
Yeah, yeah.
Got
So
it. Got it.
yeah, yeah. So the bond market, I think, has changed a lot in the last decade, probably in the last 2 decades, you would say. But certainly since 2008, where the banks used to make the market in bonds. Maybe correct me if I'm wrong on that. So how much really has the bond market changed? What what have you seen happen over the last, I'll call it 10, 12 years? Maybe describe kind of what you've seen happen through that period.
Mhm. The bond market's grown a lot in the
Yeah.
last decade. So since the financial crisis, it has grown a fair bit.
Mhm.
And if you step back and think about it in the corporate side, typically using the US as an example, 70% of corporate financings are done in the bond market. So when a company wants to borrow money, they can go to a bank or they can go to the bond market. And most of the time they go to the bond market. So it's grown a lot and it's changed a lot. So it's evolved over the years. I would say one big trend that we've seen is the growth of corporate credit within the bond market. So the corporate bond side has really, really ballooned in the last decade plus. And from a liquidity perspective, which you touched upon, so when you touched upon the banks play a very, very integral role in the bond market. So they're an intermediary. So meaning, if you have a buyer of a bond and a seller of a bond, their job is to step in and facilitate that transaction, the sale and the purchase. So
Yeah.
they are the middle person, and bonds, unlike stocks, are over the counter, meaning they don't trade on exchange. They trade old school in a sense. It's calling someone up and saying, hey, where are you on these Shaw bonds, and et cetera, et cetera. So that kind of old school fun stuff, I like to think.
Yeah.
And so even though it's massive, it is different in that sense. It still trades over the counter, even though it's a huge market.
Yeah, so I think that is extremely unique, right? But I think that's what people struggle with a little bit too when they think about bonds. As I say, it's easy to go and look and see what I'm going to sell my BCE stock for. I can go in, see the bid ask, hit it, and move on. So maybe talk a bit more about that process. You look at a 10-year BCE bond, maybe that's a bad example. And then what do? You look at Bloomberg for a level, and then you call around, and who's typically on the other side of those deals?
Right. So even though it trades over the counter, it's a very efficient market. So you
Okay.
have, as I said, it's the biggest. It's 10 times the size of the equity market. So you have every major broker dealer involved.
Yeah.
Our focus is specifically on developed markets, and we look at the triple B to single B part of the credit markets. That's our wheelhouse.
Yeah.
And then, when you focus in on that and look at that picture or that universe of opportunities, we get the dealer runs, they're called, which is like messages, Bloomberg messages all day long saying, okay, these are where the bonds are trading, et cetera. And we just monitor that very closely and look for opportunities for our clients. Yeah.
Yeah. So just set this stage a little bit. There's, from a simplification perspective, there's the AAA, AA, single A, triple B. And can you maybe just give a little scale of that, and then we can dive into some of the bonds a little bit more?
Sure. Yeah. So
Yeah.
the ratings that we're talking about, the
Yeah.
rating agencies are Moody's and S&P and Fitch, and they'll typically give a rating to bonds. And the AAA end of the market would be government bonds. And I would argue anything from AAA to single A, that part of the fixed income market, most of the returns there are going to be driven by what happens with government bonds. So most of the drivers of return or return factor, if you will, would be from government bonds. And then the triple B to the single B part of the market, that's where credit matters. So that's where someone like us as credit analysts would go in and look at the financial statements, read the covenants of the bonds, and that's where credit analysts can add value. I would argue that the triple C end of the market, which is really the riskiest end of fixed income, to me that's more like equity risk, and I don't think anyone should take equity risk for bond-like returns. So that's how to think about it. Triple B to single B credit, and triple A to single A would be more driven by government bonds,
Yep.
and triple C more like equity risk. Yeah.
Yeah, so when you talk about analysts, obviously a stock analyst is someone does analysis on the balance sheet, they take a look, they come up with a target, so on and so forth. Or a credit analyst, how would their work look a little bit differently, and what are they looking for? Like, what are you looking for within, when you're comparing maybe two energy companies, an example?
Right.
Like, what are you looking for there?
Well, credit analysts are better, obviously, but just kidding. It's the analytics are very similar. We're looking at balance sheets, and to be honest, at the end of the day, we're just trying to make sure that the company pays the coupon and that the bond can be refinanceable or get taken out of maturity. So it goes back to I would say bringing a banker's perspective to looking at a company and a corporate bond. And that's what we do from an analytical perspective. So you're looking at how much leverage is in the company, how much equity is there, what's the company's history like, usual type of analytics, and then you compare. So if you're looking at the energy sector, which we don't have a very large position there, but if you're looking at the energy sector, for example, you would take two companies and just look at where their bonds are and just compare them and look for the best value. So relative value within sectors, et cetera.
Yeah. Yeah, so I guess things have probably changed a lot too. I've heard lots about, covenant light, and a lot of the bonds, the quality has changed. Has it changed a lot, or is that more like headline reading? What's happening in that space?
Yeah, so when we talk about covenant light or light covenants, what that means is when you buy a bond, you get these covenants within the bond that protect you as an investor, as a bondholder, and they change over time. And I think they ebb and flow. So there's almost like a mini cycle within covenants. So sometimes they're a little bit too aggressive, sometimes they're not aggressive enough. But what's really neat is they can be very powerful. So you can actually make, believe it or not, money by reading covenants. And what really I find fascinating right now, given the growth of passive investing within everywhere, but within fixed income in particular, what I've seen is there's actually an alpha opportunity with the forensic analytics, meaning reading the bond covenants and reading the financial statements can add value to portfolios, especially with these very low yields. So covenants are the best, says the bond person.
So
Over dinner.
So would you find some of that in the ETF space? Like, do the ETFs play a role in some of this?
Right. So the exchange traded funds, of course, exchange traded funds are just a structure, right?
Yeah.
What's behind it is passive investing or active investing, and we've seen a massive growth of passive investing via exchange traded funds, via ETFs.
Yeah.
And so they've really taken a big chunk of the bond market, and it makes sense.
Yeah.
People shouldn't pay for beta, and if you can get beta inexpensively, then you should do that. So they play that passive role. But to be honest, there's always been a passive buyer. They just used to use mutual funds, and now they're using ETFs instead. So I don't think the structure of the market's changed per se. It's just now in exchange traded funds instead of mutual funds.
Okay, interesting. Yeah, so that makes sense. I think I had a question just a little bit about how things have played out in the markets. I remember last year, in obviously the meltdown, we had government bonds kind of go, we'll say no bid. I'm sure it happened in the corporate market too, but I remember getting a price on XGB, which is the Government of Canada bond, and it was 200 basis points off of NAV, which is the net asset value, the underlying. Like, what was going on in the bond market at that time, and maybe tell me a little bit. I know you're involved in many cycles, but this one seemed a little bit different when the highest quality seemed to a bit disappeared. So what happened?
Right. So what you're obviously specifically talking about is March of 2020.
Yeah.
When we saw a big sell-off in corporate and government bonds, basically everything. So that is what we call liquidity-driven sell-off, meaning that you had people that were forced sellers of basically everything to raise money, and the reason for it was there was too much leverage in the bond market. So there were managers that put too much leverage on their strategies in the fixed income market, and that created this panic that we saw. Fortunately, we did really well. We were, knock on wood, we were defensively positioned going into that. And what's really interesting about those periods of time is it's a great time to put money to work. So we actually bought over half of our portfolios during that period of time. And I like to say that volatility shakes good bonds out of weak hands, and kind of need to be there at those moments. And since our inception in 2009, I would say there were somewhere between 10 and 15 liquidity-driven sell-offs, and each time we're very active in the marketplace, putting money to work and taking advantage of those dislocations for investors. 2020 was definitely one of the biggest, for sure. To your point, Ben.
Yeah. So the forced sellers are, I guess, probably ETFs and things that need to liquidate. These are, and leverage, as you say. So you come into it, I guess, defensively, meaning you had some cash, or you had some more defensive bonds that you sold and added to ones that were more depressed. So what do you do in an environment like that, and how do you kind of react to those kind of events? Yeah.
So it's how do you trade or manage money through a sell-off in the asset class? So if you think about it, the difference between bonds and stocks. So stocks, there's no guarantee. In bonds, you have a guarantee. Every bond is issued at $100, and every bond matures at $100. So we call that par. So when a bond sells off a lot, you have that pull back to par. So you have that guarantee, which you don't have in the stock market. So when the stock market sells off, you don't know it's going to go back for sure. But in bonds, you do have that guarantee, so you have that pull back. So if you can imagine a V sell-off, during that period of time, if we're negative on the markets, it's usually because of valuations. We think it's rich. Like, I think the market today is very expensive. So we tend to be more defensively positioned, which means more cash. We have some shorting within the portfolio. So we'll short the expensive parts of the market, meaning we believe that it'll go down, and we want to protect the portfolio with those shorts. And as the market sells off, we'll start to put money to work as you get into the trough. and then you get that recovery as we've typically seen as well. So it's sounds easy, right? Ecstasy in the details.
Yeah, I know it's not easy, and I remember talking to you, I think in 2015 when energy was selling off, and you did a similar late in the year. You had a similar scenario where you put money to work when in corporations that were beat up. So how do you short bonds? Are you short bonds or what? How do you do that?
Yeah, so our strategy is focused on credit,
Yep.
and we aim to get a corporate bond-like return with less volatility. And to me, a true north benchmark for our strategy would be something like a coupon-like return, so 5 to 7% through cycle. So we've been able to deliver something different in portfolios from a corporate bond perspective, and it's long short. So
Yep.
going long a bond is easy, right? You buy the bond, you collect the coupon, and you have the bond mature. Going short a bond means that you're selling the bond and you're hoping it goes down in price so that you can profit from that. So for example, best example you could give is a house example. So if you were to have a house that you believe is worth $500,000 currently, and you think the market's going to go down, and you sell that house for 500,000, and let's say 2 years time you buy that house back at 300,000, then you made effectively a $200,000 gain. That's the idea of shorting. So we short corporate bonds, and it's part of the hedging tools where we aim to help protect the portfolio.
It's a unique strategy. I mean, there's not too many people that do that in Canada, anyways. So you borrow the bonds from somebody to short them, like the banks typically would do that?
The banks or other asset managers. So if you wanted to lend me the bond, I pay you the coupon, and I go out and sell that in the marketplace and hope to buy that back.
Okay.
To me, it's the banks have always been doing long short, and to me, it's an essential part of managing money. You just have to know how to do it.
Yeah, for sure. So I'd just like to shift gears a little bit and talk maybe a little bit about, sometimes bonds are, we talk about kind of the duration of the bonds, kind of the length to maturity, and it's still, I'd say, fairly misunderstood how that works, what the impact is. So maybe can you tell me a little bit about duration, what it means to the bond, and maybe we can talk a little bit about that.
Wow, duration, bond math. Here we go.
Well,
I can pull up my Fabozzi textbook if you like. We have something like 5 or 6 definitions of duration. It's ridiculous in the bond market. So really, the way that I like to think about duration, it's kind of like a PE ratio on the stock side. Okay. So if you think about it, it's how much time it takes to get your money back. So if you have a bond that has a 5% coupon and it's a 5-year maturity or term, then the duration is pretty close to 5 years. It takes you 5 years to get your money back. It's a little less than 5 years. So that's how to think about it. And the reason why it's really, really important today is because of the transformation of the fixed income market. We've seen yields go really, really low and duration start to increase high. And so what that means is investors have been reaching for yield by buying longer dated bonds, which has a higher duration, and in doing so taking on more risk. So my favorite bond math to look at, which we've talked about obviously, is when you're analyzing a portfolio or a bond, is to look at the yield you're going to get, which is the total return potential, yield, divided by the duration of the bond. And if it's a strategy that you're looking at, yield divided by duration, which means how much money are you going to make versus how much risk you're taking. And unfortunately, in a lot of the bond market, that's basically the worst risk reward we've seen in history. So not a lot of yield for a lot of duration risk. So even though it's not a fun conversation on a Thursday night at 8 p.m., it's a critical one to get yourself under and understand a little bit for sure. So it's a great question.
Yeah.
Bond math. Here we go. Bring it on.
Well, I know you're
convexity next. Can we get into
convexity? I don't know if we're going to go there today, but
not today, but a day like today. That's what my grandfather would say.
Over in obviously in North America here, we still got positive yields. In lots of parts of the world, the yields have gone negative. That's still a pretty obscure thought for people to think about. Maybe you can give me your thoughts around what negative rates look like, what it means. Do you participate in any negative yield bonds? Like what's your thinking around what's happened?
Right. We do not participate in negative yielding bonds. So our focus again is on corporate bonds and developed markets. So mostly U.S., Canada, Europe, and then we aim to get, as I said, a corporate bond-like return.
Yep.
But what we've seen really is just given the monetary policy that we've had globally, Bank of Canada and then the Fed, obviously in the U.S., they've really pushed yields down low, and it's been tough for savers, obviously. And the intention with that is to stimulate the economy. So the intention of monetary policy is basically to push money out of the savers' pockets and get that into the economy to stimulate things. So that's what they've done. And in the process, they've pushed yields very low and near zero, and in some cases negative in certain parts of the market globally. Yeah. And the challenge is that obviously you're not going to get the income. But the other challenge is it's going to be tough to get that protection that you're hoping to get from those bonds. So therefore, traditional bonds are going to have a really tough time delivering, in this low yield, higher volatility at times market.
Yeah, for sure. It's the challenge right now. How do you manage risk in this environment, right? Where you're the other side of that teeter-totter doesn't protect you as much anymore. So it's definitely a unique challenge.
Yeah, for us, there's always something to do. As I said, the bond market is 10 times the size of the equity market, and there's always things to do. And so both long and short. So we actually see really interesting ideas. I think our opportunities for investors. I think the trick is to try to empower people that have a resiliency of process and have more tools to be able to navigate this fixed income market, find the really good opportunities, and also aim to hedge the risks that exist.
Yeah, I know a few years ago you're participating in some Australian bonds that you found a unique opportunity where you ended up negotiating and they bought back some of those bonds. Can you maybe describe a little bit about that kind of idea around where those kinds of opportunities present themselves?
Right. Wow, I can remember that. That was a while ago, that conversation, Ben. See, who doesn't make bonds interesting? If I can't make you remember a bond trade in our portfolios, come on.
Yeah, right?
I think bonds are pretty.
Everything.
Oh, okay, you're one of those. Gotcha. Good for you.
Remembers every trade he ever did.
Oh man, probably the bad ones haunt you, huh?
They haunt me for sure.
Mostly me as well. So okay, the way we organize the portfolio, and really it's been based on my career history, is we have 3 segments to the portfolio, and one is patient capital, and that's coupon clipping and defensive bonds. So there we're aiming to get that steady income. And then the second segment of the portfolio is I call special situations, which is yield with upside. And in that category, it's you have an attractive yield, but more importantly, there's some kind of capital gain potential. That's where I see a lot of opportunities today in the capital markets. And then the third segment of the portfolio would be shorting. So shorting a corporate bond because we think it's expensive and we want to short the bond and potentially profit if that bond goes down in price. So to answer your question, that falls in that event-driven side of our portfolio. And the real drivers behind it, it's all process, is some event happens in the marketplace. So in this case, we had the opinion that the bonds were going to get taken out by National Australia Bank, which is the bank you're referring to. So event happens, we throw a SWAT team on it of analysts to look at the situation and then identify if there's an opportunity. And a big part of the opportunity is reading the covenants, reading the financial statements, imagine, and also having the common sense of thinking like a CFO. So if I were a CFO of this company, what would I do? And that's exactly what was behind that situation and others like it, National Australia Banks at that particular point in time. So we knew the bank wanted to get rid of these bonds, so we bought them, and then we called them up and said, hey, you want to buy these back from us? And they said, sure. So we sold it to them on 2 occasions.
Nice. I know something kind of similar has happened in Canada recently with the preferreds, and they're starting to issue some new bonds. Maybe can you tell me a little bit about what's happened there? Because I've had questions from clients like, why are these preferreds going from 15 to 24 overnight? Like what
Right.
what are the banks doing from a credit perspective? And the thinking too is, I also do have a question just further about prefs. Is I often get the question from clients, why do the banks issue 5% coupon prefs when they can issue 2% coupon bonds? Like what's
Right.
the thinking behind it? Maybe you can elaborate.
Sure. It's all about the capital structures. And so if you step back and say, how does a bank finance itself? And this is global banks, any bank. So the way the bank finances itself is it has equity, so that'd be the stock in the bank. Then you have hybrid, which can be bonds or preferreds. Then you have unsecured above that, and then you have deposit notes at the top. And after the financial crisis, the regulators globally had said that hybrid part of the capital structure, right above stocks, they wanted to make sure that could easily be converted into equity in the event of financial crisis. So they changed the rules basically for the banks globally, and that's been a big theme within our portfolio in corporate bonds that we've been involved in. And National Australia Bank was one of them, and we remain very active there. We were very active in the Canadian bank bonds as well, and for a little while we were involved in the preferreds, but not anymore. What's happened in Canada is it was the only market, interestingly enough, in the world that issued these prefs for that hybrid part of the capital structure. Most other banks had bonds. And in Europe, they call them discos. They're also called AT1s. And what happened last year was the regulators in Canada changed the rules, and they allowed the Canadian banks to start issuing bonds instead of prefs. And that's how you saw that pref market catch that big bid that we saw in spring of last year. So in other words, now the banks are financing that first loss position right above equity in the bond market instead of in the preferred share market. And that's really, I would say, in convention with what we have globally. Canada was the standout. So what you're going to have is a big chunk of the pref market's going to go away. Those prefs will get called over the next several years. So, and that represents over 20% of the Canadian preferred share market. That's going to be a big interesting change to our market for sure. Well, pref market, that is.
Yeah, and that should help the banks with funding, right? Reducing their
Absolutely.
costs. Yeah,
Absolutely.
Yeah. Interesting. I think that the corporate market's still very misunderstood too, and I'm trying to maybe try to educate people as much as we can. Maybe you can describe what you see today. Obviously, when you look at the high quality market, it tends to be a signal for what's happening in the macro picture, right? So I talk a lot about U.S. 10-year, and I use that kind of as my macro guidance. I think I would agree with you. I think the bond market's smarter than the equity markets.
Wow. I was being facetious.
No, that I think it tends. I look from a quality perspective that I think the bond market tends to lead equities in my view. So, do you look at that? Do you use a macro framework too when you're thinking about the portfolio construction, or is it like let's just focus on the credit within the businesses?
Right. We come at it from both sides, so bottom up and top down. And investing and managing money is hard and difficult, and it's absolutely obviously a lot of trust that we're empowered with. You are and we are. So you got to work hard. You got to come at it from both sides. So we look at it bottom up on a single name basis, and then of course we take a peek at our macro opinion. And when I look at the market today, to me, the biggest concern I see is lack of margin, safety margin. So safety margin meaning, what I mean by that is there's not a lot of yield or a lot of credit spread to absorb volatility, whether that volatility comes from government bond yields going higher or whether it comes from corporate bonds selling off. So that's kind of the big what of it when we look at credit today.
So maybe we can continue on with that from the perspective, like, what's obviously spreads are extreme. I think we're at all-time lows, aren't we? With high yield to governments.
Yeah, high yield and investment grade corporate bond spreads are at the lowest in history.
Yeah.
So, and if you think about it, like when you buy a bond, that spread is really just the difference between what the government bond yield is and what the corporate bond yield is. So if a coupon, for example, is 5%, and let's say the 10-year government bond is 2.5%, then that means there's 2.5% of credit spread.
Yep.
So yeah, those spreads are very low for both markets, and so not a lot of margin safety. That means that process is really, really, really important. The
Mhm.
process of the manager and their ability to pick credit really, really matters.
So how much are the central banks playing a part in maybe impacting some of that?
Yeah, central banks have been very active through their monetary policy programs. So the tools they have include yield curve or yield management, meaning they want to keep yields, borrowing costs at a certain level. So they
Yep.
want to keep them low, and that stimulates the economy. And then in addition to that, they've introduced on a few occasions, and they still are, quantitative easing. And quantitative easing means they go out and buy bonds in the marketplace, and the intention again is to push yields down. And
Yeah.
in the case of what we saw last year with that volatility in the spring, they actually entered into the corporate bond market and
Yeah.
bought bonds at that time
Yeah.
in Canada, in the U.S., and in Europe. So the central banks are critical. I believe that the message is changing from them, and we saw that this year, and that's why government bonds have sold off and why a lot of the bond market has had a difficult time. And that's because the central banks are saying, you know what, the way I look at it anyway is justified higher yields are okay. Meaning if the equities are at the highs and financial indicators are getting better, yeah, government bond yields are supposed to be higher too. And so they're allowing government bond yields to creep higher. That's what we've seen year to date, and I believe that's going to continue.
Yeah, worst start since 1980 for the bond market, right?
Yeah,
Yeah.
it's pretty tough.
Yeah.
Not for us, thankfully, because we have that ability to go long and short, so we're able to profit from that for the portfolio.
Yeah. Awesome. Awesome. Yeah. So
So on that
go
note,
ahead.
Ben,
Yeah.
sorry.
Go ahead, Scott.
Sorry, on that note,
Yeah.
like you've talked a lot on the show about you think there's a big opportunity coming up in bonds.
Mhm.
Why not just kind of speak to that, Ben, and then have Phil kind of riff off of that take?
Yeah, well, we may have slightly differing views from a timing perspective, but my base case is the back half of the year we see slowing GDP and slowing inflation, and so I expect Q2 to obviously be a big number in the U.S. and Q3 to be probably 50% below that big number. So I expect Treasuries to rally in the back half of the year. So like personally, so I've added some duration into portfolios, and I've been putting some money into the 10-year and some in EDV, which is, obviously long dated bonds, because that's my short term view. So obviously we may have differing views, and you can comment on that, but I'm doing that from the perspective of my macro views. We see slowing. I see equities roll over. You might agree with that view. I think equities are extended, so that's really my current view.
Tell him
Reasonable
why
minds,
he's wrong. Tell him why he's wrong, Phil. Tell him
no,
why he's wrong.
reasonable minds can differ. If you step back and say what drives government bond yields, so what are the drivers behind that?
Yep.
There are three. So one is central banks.
Yep.
So what is central bank policy? The second is inflation expectations, which you just talked about. So you're of the view that for now we're going to have some big numbers and then things slow down.
Yep.
And then the third driver of government bonds is supply.
Yep.
And we're going to have an unprecedented amount of supply in the government bond market because all the fiscal spending that's happening, which in the U.S. is second largest fiscal spend since World War II,
Yeah.
that has to be financed. So supply is the big headwind. I think that needs to be priced into that thought process. But at the end of the day, we had a big sell-off. Government bonds went in the U.S. went from 90 basis points to somewhere between 150 to 170. It feels like we're range bound for the moment.
Yeah.
After that big move, and we'll see where we go from here.
Yeah, I think supply is going to be an issue long term and probably weakens the U.S. dollar long term. This is my 6 month view. Is that we got up into the one. I think we would touch 176 at the top, and then we've been pulling back from there. I don't know. I mean, where the spending is going to be dramatic. I know the U.S. is buying $120 billion. FOMC is buying $120 billion a month. I know Canada seems to say that they're going to taper. So have you seen this materially impact? I mean, it feels like the central banks are saying, how much can we let this go before it puts pressure on? Is that
Right.
is that what you see when you're actually looking at that, or is that something you?
I would say the move we had, to your point about the sell-off this year in bonds, has been very dramatic. So to have U.S. 10 years go from 90 basis points to 170, That doesn't sound like a lot in the big picture. 200-year average for 10 years, something like 5%. But that's a massive move. It's almost a doubling of the yield. And I would say that the corporate bond market and the equity market actually absorbed that change very well. And compared to the taper tantrum in 2013, where everything got really spooked by the idea of the central banks no longer purchasing bonds and starting to taper,
Yeah.
we saw big sell-offs everywhere. Here in this market today, we actually saw equities doing better.
Yeah.
And we saw corporate bonds absorb that, for the most part, absorb a lot of that sell-off. Now, investment grade is, obviously felt the sell-off in government bonds, and that's why a lot of investment grade product is down, 5-ish% year to date.
Yeah.
But the functioning of the market has actually been okay, meaning things are trading okay. You don't have that big fear or the big outflows.
Mm-hmm.
So I would reasonably argue that this has been an orderly sell-off in the government bond market, and the markets have taken it the way that it typically does historically, which means that the equity markets do better because yields are going higher, government bond yields are going higher because the economy is supposedly better. So therefore, stocks should be better.
Yeah. Do you have, I know we're getting kind of off track on bonds a little bit, but we have some precedents where Japan got into a similar situation in the 90s, and then we had kind of perpetual rates getting pinned on that zero. So you're of the view, I guess, that we have more like this is a more healthy sign that yields have crept a bit higher. It's a little bit more healthy.
I believe so.
Yeah.
They're higher for a reason.
Yeah.
And as I mentioned, it's been such a big sell-off. It makes sense that it stabilizes for now.
Sure.
But the question is it a reprieve or is it a correction? That's remains to be seen, obviously.
Yeah. So we got, interesting demographic setup here, right? We got the baby boomers all retiring. They all need income. They all need to find a way to do that. Do you see kind of globally as you look, obviously, in these other markets where, bonds are zero and negative. Like, have you seen portfolios shift more towards similar products to yourself? Like they're higher yielding? Have they stayed with a kind of balanced portfolio? Do you think that still exists, or what have you seen in your travels?
Well, I think, again, the bond market is very big, and the bulk of the participants are pension funds and insurance companies that match assets to liabilities, and that will always remain, I believe, the heart of the fixed income market. And then obviously there's asset managers and retail investors as well within the mix.
Yeah.
So we've certainly seen a change, and we've seen a reach for yield in fixed income, which has resulted in the growth of the triple B part of the investment grade market. So that went from 25% ish in 2009 to basically 50% of the investment grade market.
Wow.
And we've seen the high yield market grow substantially as well since 2009. So really, a reach for yield has basically pushed many investors into taking on more risk just to keep yield the same. And that's why we had this correction, is because of that push for yield and reach for yield. It just makes it really tough to navigate as rates go higher.
Yeah. So do you think that we see a quote unquote, rebalance of rates? Like, do you think we're into a period where rates kind of move a little bit higher? Like, do you have targets when you think about that, or no?
Yeah, I think we look at that a lot, and we have views. So in coming into the year, we were of the view that government bond yields were going to go higher, and we increased our shorts in the government bond market to express that view for clients. Mm-hmm. And now at this point, though, it's kind of in that middle point. So when I think of macro investing, to me, you can have opinions at the outer ranges. Yep. So when things are really cheap or things are really expensive, but when you're in that middle part, it makes it a lot more difficult. So to me, we're in the middle. So it makes it a lot tougher. To longer term, I believe a reasonable yield for the U.S. 10-year would be kind of like an inflation yield. Okay. So nominal inflation of 2 to 2.5%. That longer term makes sense to me for the U.S. 10-year. That 2 to 2.5. As we talked about, we're only at 170 now. I don't think that happens soon. Yeah. It feels like after the sell-up we have, things could stabilize for a little bit.
Yeah. That's good. I think it's interesting. It's you get to see all of it with the macro and the kind of the bottom up. So maybe you can tell me a little bit about how you kind of look at the universe and say, this is where the opportunities are, because you've moved in the different countries. I know primarily here, but why would you look at Europe or Australia? Why would you look at those places? Are there any of those places out there today?
I don't see a lot of geographical opportunities. We don't participate in the emerging market
Yep.
Part of the bond market
Yep.
for the most part, because we don't have an information advantage there. We focus in on developed bonds.
Yeah.
And to be honest, most desirable international issuers will actually issue US pay bonds as well.
Yeah.
So the US market becomes a key spot for us to look.
Mhm.
And then finding opportunities, we take the whole corporate bond market and we analyze it, and we have some quantitative tools that we use to simplify it. And then we dive in and see if there's some opportunities. We have tilted the portfolio more towards the special situations segment, so more towards event-driven credit investing.
Okay.
And I think that's a really fascinating part of capital markets right now, because of these low yields that exist, many companies are taking out old bonds and issuing new low coupon bonds for longer periods. And what we're doing is looking for those older bonds to potentially buy and have potential takeouts. So the event-driven side of credit investing is really, really interesting with these low yields. It kind of sounds sort of non-intuitive, right? But low yields actually driving events within the credit market.
Gotcha. That's interesting. So the U.S., obviously the U.S. is where most bonds get issued. I guess it's still a majority of the corporate issuance. Have you seen that change at all, or has it been pretty steady? Yeah.
Pretty steady.
Yeah,
So
yeah.
in Europe, historically, 70% of financing have been done by the banks,
Yeah.
and in the U.S., as I mentioned, 70% of financing was done in the bond market.
Yeah.
And over time, we've seen Europe grow in its corporate bond market, but still the U.S. is the main spot, the main player.
So what do you do from a hedging perspective, from a currency like Canada versus
Right.
U.S.? Is there something you do there?
So our intention is with the strategy is to get a corporate bond like return. So that way, when you put it in your mix, as you can put us in that credit category.
Yeah.
And then we aim to hedge the risks in the bond market. So we aim to hedge currency risk and credit risk, liquidity risk, and rate risk. And so, we put hedges on to protect the portfolio against currency movements.
Yeah, so if you're hedging Canada versus US, like what does that cost? Like, how do you calculate that number?
It's not that expensive to put that on. So we identify how much US exposure we have, and then we'll buy futures, short-term futures, currency futures, which are very liquid and very, very, very simple, and aim to hedge the currency risk that way.
Yeah. So so do you participate in a lot of the new issues, or most of these things secondary that you're looking for the opportunities? Are there issues that come to market that are interesting as well still, or? Yeah.
Sure. Yeah, we are active in both the primary and secondary markets.
Okay.
We're one of the largest credit players in Canada, so we're very active in the Canadian space, and we're actually pretty meaningful in size in the US market as well. And I've spent a lot of my career down there, and our traders and my team, we all have a lot of experience trading US securities.
Yeah. So I think from what I've heard anyways, maybe tell me a bit, like the difference with equities, right, is equities tend to come, if a new issue, for example, tend to come to market, and the institutions don't necessarily dictate the terms. If a company's coming to market in Canada, would you have any influence over what the terms would look like, or how does that work?
So the process is similar to the equity markets.
Okay.
You have a roadshow, and the company will talk about why they're issuing the bonds,
Okay.
and they'll talk about the company and give that story. And then covenants and structure are often discussed in advance, and just to get a sense of what investors would be interested in, not necessarily company specific, but what is the market interested in. So you can kind of say, all right, well, right now people want to buy, let's say 7-year, say triple B name at 4%, seems to be kind of where the market is.
Yeah.
And then they'll enter in on that basis. So the market really drives a lot of that conversation.
Yeah. So do you ever see fixed income trading not OTC?
Well, there have been attempts to have exchange traded, but the big difference, it's structural in nature between bonds and stocks, is that for every stock, there's one ticker, right?
Yeah.
So Shaw Communication has SJR, that
Yeah.
one ticker. BCE has BC, that one ticker.
Yeah.
But Shaw and BCE would probably have over time like tens, hundreds of bonds that have been issued over the years, and they're maturing all the time. So it's really difficult to have an exchange traded product when bonds are maturing all the time. You don't have that permanency of a stock ticker, if you will. So that's the main reason why these trading platforms haven't been able to really get a lot of size. But I could see in the retail side, it makes a lot of sense. That go names, so names that are very frequently traded and familiar to everybody. It makes sense to me that they should be exchange traded, but we haven't seen that develop yet.
Yeah.
In size.
Yeah. No, it's still. I mean,
thankfully.
Yeah. I mean, it's always been something that's kind of been interesting as I look at, like, I try to understand the market, and I've been managing money for 20 years now still, and I'll look at a bond and try to understand how they got to that valuation, that price, and it's still pretty opaque, even if you talk to your bond desk and say, what's the level on this, what are you paying for it, and who are you buying it from. So I think people still don't understand that with the bond, you're buying it from another institution basically, right? Like you're buying, you're not like there's an institution sitting on the other side, right? For example.
Correct.
Yeah.
Yes.
So, so who would be the biggest places you would look for to getting bonds from in Canada?
Well, we trade with all the major broker dealers, and they're all very active in all the Canadian corporates. So we trade with each of the banks here in Canada on a regular basis.
Yeah. All right.
Yeah, and they're doing a great job. They liquidity is not what it used to be, but they still really help facilitate and keep the market moving.
Yeah.
I think they've done a really good job over the years.
Okay, that's good. Well, you've said the most interesting thing that you're working on is event driven right now. That's got your most interest. What do you think over the next 12 months? What's your expectation for how things progress, and what are you looking at maybe more longer term, or do you just stay primarily focused on what's happening right in front of you?
Well, we look, as we talked about before, you have to come at it from all different directions. So have a short-term, medium, longer-term objective. To me, credit quality seems okay. So balance sheets are okay, leverage is okay, defaults remain low. The market's expensive, and by expensive, that means not a lot of margin of safety. And so with that lack of margin of safety, that means the market is susceptible to volatility, whether that volatility comes from government bonds selling off or corporate bonds selling off. But I would say in general, kind of constructive on the credit market. From it feels okay right now. It's just expensive. So for us, being able to kind of go in and pick the names we like makes a lot of sense, and then have some hedges to help with that expensiveness.
So I'd say kind of the last question before I start to wrap up. So would the Bank of Canada, would they still be buying corporates right now, or are they primarily still in government and mortgages?
They've definitely slowed down globally, the central banks, with purchasing corporates and mortgage-backed securities, and we've seen quantitative easing really, really slow down. And I wouldn't be surprised, like you mentioned earlier, that we start to see some tapering from central banks, which again makes sense. You have stocks close to the highs, you have financial indicators better, the economy supposedly is doing better, employment's doing better, so it makes sense that they aren't as active in their purchase programs.
Yeah. Okay. Fair enough. Yeah. I mean, I was surprised at how aggressive the Bank of Canada was, but it must have been the scale and the damage that happened in March is why they stepped up so aggressively. Like, they've never been there at this size before, have they?
No, they haven't. And I think the central banks globally did a pretty good job of quietening things down last year. It was impressive to watch, to be honest. But a lot of that was reflexive. I don't know if you're into Soros, but he talks a lot about reflexivity. So just them threatening to be there was almost all they needed to do.
For sure.
Everyone knows don't fight the Fed or don't fight the central bank. So just them saying they're going to start buying corporates firmed the corporate bond market up. And they probably didn't have to buy nearly as many as they would have had they not voiced that if you know what I mean.
I do.
So I think they've done a good job of stepping in and supporting the market last year. Maybe too good of a job. But
Yeah. Now yields are where they are. Yeah. Listen, Phil, that's been awesome. I think we covered a lot of great stuff today. Is there anything else that you wanted to add? Is there any questions that I should have asked you that I didn't? Is there anything you want to close with?
Wow, that's such a great question. Whenever you're asking a manager a question, the one that should be asked is what else should I ask you? Because you'd be amazed at what people will confess, confess their sins when you ask a question like that. I think the last thing that I would want to say is this concept of margin of safety. I think a real good call to action is to step back and have a debrief and a review of what your clients own in their fixed income portfolios, which I know you do on a regular basis, and would encourage your clients and those that follow you to reach out and talk to you and have a review of their fixed income, because it is different today. And you just spend time on understanding the risks in the portfolio and really take a peek at that aggressively. That would be my main point. And then obviously I believe the business case for having an alternative income solution like ours in the mix is very strong. And we've been able to provide something different in portfolios over the years. Those would be my final comments.
Yeah, so that's a great point. And obviously you've been running the hedge fund version for 11 years, and a few years ago they came out with the liquid alternatives that you also run as well. So maybe just the nuance between those two, and then wrap it up. Are they quite similar, the hedge fund and the liquid alternative, or do they vary dramatically?
They are similar. The spirit of them is similar. So we bring us the long short credit strategy that we've been managing for many years, and we just brought it out in that liquid alternative framework. I believe the regulators have done a good job with packaging that framework for investors, and so they can get more than just your traditional long only strategy in a much easier to buy format. So yeah, similar in spirit for sure.
Okay,
Very similar.
right on. Awesome.
Yeah.
That's been great. I really appreciate you taking the time. Scott, did you have anything come up?
I learned more about bonds than I've ever learned before. So hey, you've taken my interest from a 6 out of 10 to a 6.5 out of 10.
Wow,
So,
I'll take it.
We're moving the needle. We're moving the needle.
There you go.
Hey, just before we go, tell me, are bond guys on social media? Do you have a Twitter for yourself or LinkedIn that people can follow you?
Well, we do have our firm LinkedIn, and I have a personal LinkedIn as well.
Okay.
But I'm not very active on the social media side. But we do communicate through LinkedIn, and obviously we talk to you folks on a very regular basis about what's happening.
Yep.
What we're seeing in the bond market, and have that partnership approach to the business.
Definitely.
that we like to focus on.
Yep. Absolutely. Yeah, that's been
for
awesome.
sure.
No one needs me twittering, that's for sure. What would I say?
Yeah, well, maybe there's
Oh my gosh, look at the coupon on that one. Oh my goodness gracious. Did you see that 4 3/8 coupon? I think it rallied. It's yielding now 3 7/8. Believe it or can you believe it? We don't get invited to too many cocktail parties, us bond folks.
You could start some pretty epic bond Twitter battles, though, I bet.
Yeah.
Imagine.
Awesome.
Anyway,
Yeah.
thanks again. We really appreciate it. You've been a great guest, and we hope that you come on again.
Sure. Thanks. It was a lot of fun.
Yeah.
Take care.
Appreciate
Bye,
it.
guys.
Yeah,
Awesome.
thanks.
Bye, everyone.
Awesome.
Thank you.
Thanks.